When you invest money, where does your profit come from? Hi, I'm Tom Crosshill and this is the Index Investors channel. And today we're going to dig deep into the basics of investing. A lot of new investors get distracted by all the shiny toys, stocks and bonds and gold and crypto and forex and whatever, all the jargon, and they lose sight of the big picture. They forget to ask, where is my profit going to come from? And as a result, they choose poor investments, lose their money, or receive suboptimal returns. In this video, we're going to make sure that doesn't happen to you. We're going to ask 4 questions. First of all, what is the difference between redistributing wealth and creating wealth? Second, why is redistributing wealth a losing idea when it comes to investing? Third, when new wealth gets created in the world, how is it distributed? Who gets it? And fourth, what are the investments that let you benefit from all the wealth creation happening in the global economy? So let's start with our first fundamental question. What's the difference between wealth redistribution and wealth creation? It seems like a really obvious thing, and it is obvious when you think about it, but a lot of people don't think about it, and as a result, they make poor investment decisions. So first, consider this scenario. You are a smart but slow criminal mastermind. You have figured out how to print euro bills, how to print money. You take 1 full month to print 10,000 euros for yourself. Have you created wealth? Well, you individually are certainly wealthier. You can buy stuff with 10,000 euros, right? But is society as a whole, is the economy wealthier? Of course not. If it worked like that, then the European Central Bank could just print 10,000 euros for everybody and we would all be richer. But of course, all that happens instead is that the value of money decreases and it gets redistributed from everybody to those people who are printing money. Okay? So that's a clear-cut example of redistributing wealth. Now look at a second scenario. You are a talented software developer and you spend the same amount of time, a full month, to develop a new and useful piece of software for your client, a company that pays you 10,000 euros. Have you created wealth? Well, you individually, again, are 10,000 euros richer, so that's nice. On the other hand, the company is 10,000 euros poorer. So in pure cash flow terms, it seems like, again, it's a zero-sum game, right? However, we mustn't forget that you have created a new and useful piece of software that the company can now use. So the net result of your activity is positive. You have created value. I would say you have created wealth in this scenario. So basically, wealth creation comes down to this question. Are you producing something that has intrinsic value, or are you just trying to shift things around in such a way that somebody else has less and you have more? Now, in our daily lives, most of us prefer to be productive members of society, right? There are people who build their entire lives around redistributing wealth. There are criminals, there are corrupt politicians, there are gamblers, there are very cynical financial executives who just want to charge a fee and get as much money out of you as possible without actually giving you any value. But most of us, sure, we want to make money, but we also want to create something of value to help people, right? But when it comes to investing, a lot of new investors kind of naturally gravitate toward activities which are essentially wealth redistribution. They try forex trading, where the whole idea is to buy and sell currencies in such a way that you make money and somebody else loses. They day trade stocks, they speculate with gold or crypto, they engage in all kinds of trading activity which generates no economic value but simply tries to get you more at the expense of somebody else. Now, of course, there's a moral argument why this is not such a great idea. But I want to make the point that it's actually a dumb way to try to make money. It just doesn't work. So that brings us to our second question. Why is redistributing wealth a dumb idea when it comes to investing? I'm going to give you two reasons, one based in mathematics and the other in financial research. First, the mathematical reason. Whenever you try to redistribute wealth toward yourself, you are essentially participating in a zero-sum game. If you win, somebody else will have to lose. On average, mathematically, you will net out to zero. But in reality, playing a zero-sum game takes significant effort, it takes resources, it takes money. So when you take that into account, the expected result on average statistically is negative. Does that make sense? So on a purely mathematical basis, it's immediately obvious that engaging in wealth redistribution is statistically a dumb idea. On average, people who play this game on either side should expect to lose. But then you might say, okay, yes, the average might be negative, but that's just the average. What if I'm smarter than everybody else? What if I buy this super cool trading course from my favorite guru who's gonna teach me how to beat the market in Forex or day trading stocks or whatever? Then, of course, I'm gonna redistribute wealth successfully and become rich that way. Well, here we come to the second reason, which is a reason based in financial research. Decades of financial research have strongly demonstrated that it is virtually impossible for anybody to come up with a consistent system for outsmarting the market, for consistently being above the average. That's because the financial markets are complex. Millions of players participate in the market. There are many factors influencing price action. So reliably predicting what's going to happen to prices is virtually impossible. And you have to keep in mind that everybody who's in the game wants to win, and you're competing against a lot of smart people, a lot of trained people, a lot of companies with a lot of resources and all kinds of fancy algorithms and everything else. Everybody wants to win, but on average you are likely to be average, or, well, if you're just an untrained amateur investor, you're likely to be way below average. That's just the reality. And market statistics bear this out. The vast majority of Forex and CFD traders and other speculators lose money. And people who seem like geniuses in one period become losers in different periods. So there's no strong evidence that any gurus or trading experts are actually very effective at speculating and, redistributing wealth in their favor. So when it comes to investing, trying to redistribute wealth is just a loser's game. So now we understand that as investors, we don't want to try to redistribute wealth, but we want to participate in wealth creation. And this brings us to our third question. When wealth gets created, how does it get distributed? Who benefits? Well, this actually comes down to classic economic theory. To produce something, to create value, you need inputs. You need labor, land, and capital. And then once some value is created, it gets distributed to labor, land, and capital in various proportions. Now, unless you were born super rich, you have probably experienced being the labor part of the equation. Most of us, we grow up, we go to school, and then we start working at a job. We start selling our labor in return for income, right? Now, a lot of people tend to imagine that most of the income generated by companies ends up going to some greedy capitalist, to the owners. But actually, historically, most of the income in the economy has actually gone to labor. Today, I believe it's around 50%, according to various research that I've seen. But the problem is, by the time you get to my age, you start to realize that life is short. The amount of labor any one of us can sell over our lifetime is very much limited. Our hours in the day are limited. So this is actually why it's so important to start saving money as early as possible in your career so that you build up some capital and you can start participating in the other side of the equation. So if half the global income goes to labor, the other half goes to those who provide land, meaning natural resources, and capital, meaning man-made resources like machines and hardware and software and technology and all these things, okay? And we want to get in on the action. We want to start providing capital and land and get the rewards that go to capital and land, right? And this brings us to our fourth and final question. What are the investments that let you benefit from all the wealth creation happening in the global economy? Well, before I answer that, let me encourage you to hit that subscribe button and the notification bell so you don't miss out on any of the cool investing videos we post every week. Now back to our question. To choose investments which benefit from wealth creation, you should always ask, does my investment contribute directly or indirectly to providing businesses with land, with capital, or with labor? So the most obvious choices would be just to invest in company stock, in company shares, directly or through the stock market, then you're financing the capital. You could also lend companies money, for example, by buying company bonds. Or you can buy some real estate and rent it out to a company that's going to use it in its business. And then there are, of course, more indirect investments, like buying real estate and renting it out to people who need somewhere to live, and then they're going to pay you out of the income they get by providing labor to companies, which then create value. You can lend money to governments, which provide the infrastructure that is necessary for companies to be able to create value. But at the end of the day, when you are looking at a new investment, you should always ask this fundamental question, the same question with which we started the video. Where is my profit going to come from? If the big idea is to simply redistribute wealth, to take from somebody else so that you have more and they have less, well, it's not just morally questionable, it's statistically a loss-making proposition. Stay away from it. But if the fundamental idea of the investment is to either directly or indirectly provide the capital, the land, or the labor that businesses need in order to create wealth, in order to create value in the economy, then it could be a good investment and it's worth looking at in more detail. Now, I know that this video has been a bit out there. Most investment trainers don't talk about this very theoretical stuff, but I think it's really important to understand so that we're not just chasing numbers on a screen, so that we actually understand the meaning behind what it is that we do as investors. If you'd like to learn more about both the theoretical and the practical side of investing, make sure to hit that subscribe button, to hit the notification bell, and to leave a like. Because every week in our channel, we post some interesting videos on personal finance and investing, and I think you're going to learn a ton. From time to time, we also run a free investment masterclass. So if a link is popping up as you're watching this video, make sure to hit that and register. But otherwise, hit that subscribe button and I'll see you in the next video.